Welcome back to Enlightened Trading. I'm your host Conrad, and today I'm going to present you moving averages explained. This is a new format which I'm hopefully going to continue in the future, so stay tuned. This time it's about moving averages. So the content of this video and this presentation will be firstly the definition, then the varieties of moving averages, and then the implementation. So starting off with the definition, moving averages is basically a very versatile and widely used indicator, and I do think that if you are already interested in TA, you have definitely heard of the moving averages. It's actually hardly open for subjectivity because it's a programmed line on the indicator on the chart, and you can't argue whether or not it is a triangle or wedge or for example, of course. It's also usually a line which represents past price movements and represents usually a certain time horizon by average. For example, the 50-day moving averages are the last 50 closing prices added up and then again divided by 50, and then this projects a line on chart. It's also a trend following indicator and is reactive to price. So starting off with the varieties, then firstly we have the simple moving averages. It's also the mostly widely used indicator for moving averages, and it's very simple in its programming. It only includes closing prices. Of course, you could also use other prices, but for this presentation I will mainly focus on closing prices because they are also the widely used ones. And also here on a simple moving averages, it is programmed in a certain time period. Each data point is also equally weighted, which is actually a point which some people criticize for the moving averages on the simple one. So the next one will be the linearly weighted moving average. Each data point here is multiplied according to its appearance in time. So for example, if you have the 10th day or a 10-day moving averages, then the 10th day is multiplied by 10, the 9th day by 9, the 8th day by 8, and so on. This actually has the effect that a greater weight is on recent price action compared to a simple one, where on a simple one every data point is weighted equally. So as you can see also here, then on the 10-day moving averages, they are added up. For example, 10 plus 9 plus 8 plus 7 is then divided by 55. And then this also appears on the chart as a data point. And also it still only includes closing prices or price action in its programmed period. So for example, 50-day, only the last 50 days. And then in comparison to that, we have the exponentially smooth moving average, or also called just the exponential moving average. It actually assigns greater weight to recent data as well, but it includes all data of the moving average even beyond its calculation period. So for example, to the linearly weighted moving average, it would also include past 50-day time horizon, so also for example the past 100 days, but it would then just weight each past data point even less and even less, so that they are actually they make up a very small amount of the current data point. Also, it's possible to adjust weighting for personal preferences according to percentage time points. So also, yeah, as I said, they are calculated by percentage values, and all intervals make up for 100% of all data points. So for example, then here I pulled up a chart of mine. This is Bitcoin, as you can see. And we now have 3 different moving averages. We have first, I will zoom in on this a bit. You can see right here, we have the estimate, is the simple moving averages, and they are all on a 50-day time horizon. The simple one, the weighted moving average, the linearly weighted moving average, and the exponentially smooth moving average, or also called EMA. They are usually called SMA, WMA, and EMA. So, and here you can see these are actually all the same, all in the same time horizon, but they do vary in its movement on a chart. And as you can see, the simple moving averages here, the yellow one, is usually a bit lacking and needs a bit more time to move. For example, if you can see, oh, that's not what I wanted to do. So here we are again. So as you can see, for example, here, the yellow one turned the latest compared to the exponentially smooth and the weighted moving average. So they do vary in its appearance on the chart a little bit. So moving on to the implementation of the moving averages, and there are actually some different ways, of course, of implementation. First of all, you have short time scale moving averages and long time scale moving averages. The shorter time scale, they usually generate more signals, but of course there's a downside because there is more noise compared to trustworthy signals. So you have to analyze which signal you really want to take. There are also more possible short-term trades compared to longer-term and lesser trades, and also the shorter timescale moving averages recognize trend changes a bit faster. Long timescale moving averages are generating less signals, but of course they are more trustworthy because there is less noise in these long-term time moving averages. Also, there are less possible but intermediate to long-term trades. So this is usually for longer-term or swing trading positions. And also there's the downside because they lag behind in trend changes, but as I said, are then more trustworthy. So one of the ways of implementation is then using just one moving averages. It's one of the most commonly used methods, and buy signals are here generated by a price moving above the moving averages. As you can see here on this picture, for example, you can see the green arrow signaled by a buy signal here when a price moved above this line, this moving averages, moving average the 200 daily here on this point, and signaled a short entry here as price broke below it. So that is basically what this means. Very simple. And the moving average is also turning between declining and ascending. So you can see the moving average is here declining or flattening out, and then you can see the moving average starts to ascend, which also sends bullish signals. So that is also a sign of the trend. So the second one would be use of 2 moving averages, and compared to the simple one, or compared to a 1 moving average, there is a difference because you can now use the double crossover method. Popular popular ones would be the 50 plus 20-day moving average or 50 plus 10-day. And this double crossover method basically means that you have a short signal generated when the short-term moving average, as you can see, crosses below the long-term moving average. This is also called a death cross. This would not happen here. As you can see, this short-term moving average is sticking to the price much closer compared to this longer term, and as it moves below it, price also breaks sharply and moves down quite fast and generates a short signal. And here, as the moving average crosses above the longer term, it generates a buy opportunity and a buy signal, which of course would have been profitable in this at this opportunity. And this is then called a golden cross compared to the death cross. The difference, or what is also important to look out for, is that there's even more significance of the signal when the death cross actually happens when moving averages are declining, and less significant when flat or still ascending. And of course, this is also vice versa. So what this means is that it's even more significant if the moving averages, when they cross, for example here in this death cross, when both moving averages are already descending moving averages signal short-term, at least short-term bearish action, but downwards action. So as you can see, this already flattened out right here, so it wasn't too significant. But since it's already flattened out and it wasn't ascending, it would have been a nice trading signal. And yeah, also here not too significant, but of course it was in this instant. So yeah, that's that. And now moving to a third one. The third implementation would be the use of the triple crossover method using 3 moving averages. Usually you would use the 4, 9, and 18-day moving averages trading in futures, or the 5, 10, and 20-day moving average, for example, in commodities. So they are oriented towards the alignment in trends. So the difference between double crossover moving average, for example, is here that you have now 3 moving averages, and you can now for example have this closer one sticking to the price, and this is also to your preference, of course, how you want to use them. But for example, you could use the shorter term moving average for signaling trend changes very fast. And then for example, if you went long right here and price stayed above the moving average, so you kept your long position. But as soon as price breaks or consolidates on a moving average, you, for example, could then take profit. And as soon as price moves below the second one, you could then maybe enter a short trade, and as it comes up to the third one, you could then maybe even again take profit on your short trade. So that is a use of these 3 moving average. But of course, you could also use them simple to the crossover method here. When all 3 moving averages cross, and it's even more significant compared to when only 2 do. So also there is another way of looking at this implementation, and this would be moving average envelopes. For example, as you can see right here on this picture, here at the bottom, the bands are moving above and below. So you have this moving average here on this chart, the blue one, and then you have the upper band, the green line, and the lower band, the red line, which are moving in percentage points compared to the moving average up and below, and would in uptrends signal that they are a short over oversold prices, and you could use the bottom line as entry points, and in downtrends you could use the middle line as shorting opportunities before then price breaks below it, and you could then take profit again. So that would be a way of using moving average envelopes, and in general using moving averages. Of course, there are a lot more methods for using these moving averages, and usually they vary in personal preference, especially when it comes to in which time horizon they are generated and what time horizon they respect in its analysis. So actually, that's it already for this presentation on moving averages and its and their implementation. So thank you very much for watching, and if you found this video helpful, then I would very much appreciate subscribe to my YouTube channel, or a like below it, or better even, and a like below it. Also comment down below how and if you found this presentation useful. It did make take up some time, but you know, I do this for free, so I would even more appreciate if you appreciate this video. So again, thank you very much for watching, and I'll see you guys and girls and people back next time. Bye.